Greetings. Welcome to another episode of What's in It for My Money. I am your host, Andre Gordon. On today's episode, we're going to focus on stock market indices. But before we get started, please don't forget to smash the like button and hit that subscriber button to get updated weekly content. With so many people focused on investing in today's market, I think it's equally important to understand where your investments are being placed, just as it's important to understand what your investments are. Stock market indices around the world are powerful indicators for both global and country-specific economies. In the United States, the S&P 500, the Dow Jones Industrial Average, and the NASDAQ Composite are the three broadly followed indexes that are closely watched by the media as well as investors. In addition to those three primary indexes, there are approximately 5,000 other indexes that make up the U.S. equity market. Out of the 5,000 market indexes that make up the U.S. equity market, the three most commonly followed we mentioned before were the S&P 500, the Dow Jones Industrial Average, and the NASDAQ Composite. Even though all of these indexes are classified as market indexes, indexes can be constructed in a variety of ways and can focus specifically on certain sectors of the U.S. equity market. With such a large number of indexes, the U.S. market has a number of methodologies and categorizations that serve a broad range of purposes. National, regional, and local media tend to report on the direction throughout the day of the three main indices that I mentioned before, with key news items that can serve as both contributors and detractors. For your investment and money managers, they use those three main indexes as benchmarks for performance reporting, while investors of all types use the three major indexes as performance proxies for allocation guides and rebalancing strategies. Indexes also form the basis for passive index investing, which is focused on tracking indexes specifically through exchange-traded funds, or ETFs. A more thorough understanding of market indexes, how they're constructed and utilized, can help all investors understand clarity around these investment avenues. Let's take a broader look at the three most commonly followed indexes in the U.S. equity market. S&P 500. The Standard & Poor's 500, commonly known as the S&P 500, is an index with the 500 top companies in the United States. Stocks for the S&P 500 are primarily chosen by capitalization, but the committee also looks at several other factors that are important to the selection to the S&P 500. These would include liquidity, public float, sector classification, financial viability, and their trading history. The S&P 500 represents approximately 80% of the total value of the U.S. stock market. In general, if you want a good barometer of how the U.S. equity market is performing, the S&P 500 is the benchmark. Indexes are usually market-weighted or price-weighted. The S&P 500 is a market-weighted index. Market-weighted refers to capitalization. Every stock on the S&P 500 is represented in proportion to its total market capitalization. In other words, if the total market value of all 500 companies in S&P 500 drops by 10%, the value of the S&P 500 index will drop by 10%. The Dow Jones Industrial Average. Dow Jones Industrial Average is one of the oldest, most widely known, and most widely used indexes in the world. The Dow Jones Industrial Average includes the stocks of the top 30 largest and most influential companies in the United States. Dow Jones Industrial Average is a price-weighted index. It was originally computed by taking the per-share price of the stocks of each company in the index and dividing this sum by the number of companies on the index. For example, a dollar price change in a $120 stock will have a greater effect on the Dow Jones Industrial Average than the $1 change of a $20 stock, although they may have changed respectively 0.8% and the other by 5%. As things change over time, so does the complexity of the market change over time, and the Dow Jones Industrial Average can no longer be calculated in this simple format. Over the years, with stock splits, stock runoffs, and other financial crises, it has impacted the calculation of the number that is divided with the Dow Jones Industrial Average to making that a very small number and no longer applicable. However, a percentage drop in the Dow should not be interpreted as a broader direction of the overall U.S. stock market, similarly the way that the S&P 500 is a benchmark of the overall U.S. stock market. Dow Jones Industrial Average represents about a quarter of the entire U.S. stock market. The reason for this is twofold. One, the Dow Jones Industrial Average is a price-weighted index, comparative to the S&P 500, a market-weighted index. The Dow Jones Industrial Average looks at the top 30 companies in the United States. The S&P 500 looks at the top 500. Change in the Dow represents a change in the investor's expectation of earnings, as well as the associated risk of the companies that are represented in the Dow Jones Industrial Average Index. Because the general attitude toward large cap stocks differs from the general attitude toward small cap stocks, international stocks, or technology stocks, a change in the Dow should not be interpreted as a general sentiment of all U.S. equity markets. Overall, the Dow is known for listing the U.S. market's best blue chip companies that regularly and consistently offer dividends. With that being said, while the Dow is not a good representation of the overall sentiment of the entire U.S. equity market, it is a strong representation of the top blue chip companies offering dividends and the value within that market. NASDAQ Composite. Most investors are aware that the NASDAQ Composite is where technology stocks are traded. NASDAQ Composite Index is a market capitalization weighted index of all the stocks that are traded on the NASDAQ Stock Exchange. One of the unique things about the NASDAQ Composite Index is that it has a number of companies that are not based in the United States, although they are traded on an index that is based in the United States. Best known as an index that's heavily tech-focused, the NASDAQ also features several other sectors, including biotech, software, semiconductors, finance, industrials, insurance, and transportation. NASDAQ Composite includes large and small companies, but unlike the Dow and the S&P 500 that focus on large companies, the NASDAQ Composite has a number of small companies with very small market capitalizations included in their index. As a result, any movement within the NASDAQ Composite Index is really heavily weighted toward technology stocks, as well as investors' attitudes towards some of the smaller speculative companies and their market capitalizations. The Wilshire 5000. Wilshire 5000 is also known as the Total Market Index or the Total Stock Market Index because it includes all publicly traded companies that are headquartered in the United States and has readily available price data. Established in 1974, this index follows the entire U.S. stock market and its aggregate movement. Although a very comprehensive measure of the entire U.S. stock market, the Wilshire 5000 is referred to far less often than the more popular S&P 500 index. Generally, there are a few ways to examine indexes more broadly. Capitalization is usually the key. They usually have the indexes fall into one of three buckets: large, mid, or small cap buckets. The S&P 500 and the Dow Jones Industrial Average are two of the top large cap indexes, but other indexes include the S&P 100, the Dow Jones U.S. Large Cap Total Stock Market Index, MSCI USA Large Cap Index, and the Russell 1000. Other notable mid-cap indexes include S&P Mid-Cap 400 and the Russell 1000, the Russell Mid-Cap, and the Wilshire US Mid-Cap Index. In relation to small caps, the Russell 2000 is the 2,000 smallest stocks from the Russell 3000. Small cap indexes include the S&P 600, Dow Jones Small Cap Total Stock Market Index, the Dow Jones Small Cap Value Total Stock Market Index. What's the bottom line for my money? Index play an important role in the overall analysis of the U.S. equity market. Indexes provide a great deal of understanding and insight into the overall economy, the investment public's appetite for risk, and trends regarding investment diversification. In general, it's important to understand the nuances of these indices, including their composition and their construction, to help you make sound financial decisions and decisions that are going to be able to impact your money now and in the future. To simplify it even further, let's use this analogy. that we can relate to on a daily basis. Looking at the vehicles that we drive in context to the system of highways, roadways, and byways. Many of the investment strategies that we talk about on a regular basis are considered vehicles. Those would be Roth IRA, mutual funds, bonds, or even individual stocks. These indexes are the system of investment highways, roadways, and byways of which our investment vehicles travel upon. Just as you set out to travel to a destination, you understand the differences between a highway, the roadway, and a byway in order for you to get to your destination both safely and effectively. In a similar fashion, it's important for you to understand these systems in terms of investment strategies and how your investment vehicles will perform on these individual systems that will help you get to your financial destination. Now, you have a better understanding of each of the market indexes, the overall composition, and how it impacts you and your money. And that is it, a summary of all of the market indexes for the U.S. stock market. Please don't forget to smash that like button and hit that subscriber button for updated weekly content. Thank you for tuning in.